Hello everybody, welcome to Know Your Money. I'm Bronwyn Weiner.
And I'm Craig Finch, and we are from Growth Financial Planning. We hope you enjoy our podcast.
Hello everybody. Today we have Clive Lazar from Just Retirement again. In our previous episode, he explained a little bit of the underwriting and that Just Retire does things a little bit differently. So Clive, if you can just introduce yourself and just explain to us how the industry does it and how you do it differently and how you doing it differently impacts or helps the client.
Morning, Clive. And
morning.
Good to see you again.
Morning, Craig. Morning, Bronwyn. Thanks for inviting me. So my name's Clive Lazar. I'm the Regional Manager for Just Retirement here in Johannesburg. So we can focus specifically about Just Retirement and what we do differently, which is we do underwriting at retirement. And it's quite a unique concept and quite a reverse sort of psychology of what we see in the industry. So perhaps just to explain it in a way that makes sense for your listeners. Normally when it comes to underwriting, people have a lot of negative connotations about it because they're associated with when they buy life insurance. The insurer will do a whole lot of assessments, medical assessments, and then they're either going to give you what we call a standard rate, or they're going to load you, they're going to give you a higher premium, or they could even exclude you if you've got some serious medical conditions or medical factors. So now we turn that on its head, because what we do is we say that we want to treat customers fairly at retirement. And what happens in the industry is that when somebody retires and they take their fund credit and they go to the insurer with that fund credit, that capital amount, and say, here we go, can you give me an income now? That what's happening is there's a massive amount of what we call cross-subsidization. Cross-subsidization is a very good factor, and it's one of the important foundations of a life annuity. However, there's good and bad cross-subsidization. And when it comes to underwriting, this is where we allow the good cross-subsidization, not the bad cross-subsidization. What I mean by that is the other insurers, what happens is they just look at your age and your gender and your fund credit. So what you have is you have a scenario where there's bad cross-subsidization in the sense that the poor are subsidizing the rich and the sick are subsidizing the healthy. In other words, the way the annuity has been priced is there is cross-subsidization effect that's happening in that pool across the members. We don't want that to happen. We want to treat each member fairly. So what we do is we say, okay, let's look at your specific situation. So not just your age, gender, and fund credit, but let's look at your medical history. Let's see, did you smoke? Have you worked underground? Do you have any medical history? Like, have you had strokes, heart attacks, cancer, diabetes, all the well-known traditional diseases? And let's factor those medical conditions into the price of your annuity, such that if, according to the medical information you provide us, we believe that your life expectancy is shorter than the average, we're going to give you what we call an enhancement or an uplift to your starting income.
So what you're sort of saying is the normal industries, the normal providers, there's R1 million and there's two clients. And one has cancer and the other one is completely healthy. Those people will both get, for example, R5,000. What you're saying you guys do is you take into consideration that the person with cancer is not going to live till 82 likely because they might, but most likely not to because of those factors. So instead of that person getting R5,000, you would give that person, for example, R7,000 because they're going to get their money out that they've given in. Is that?
That's spot on, Bronwyn. Okay. Spot on. That's exactly well put and explained nicely for your listeners. And so just to then expand that, so we look at that medical information. And maybe just to explain it a bit further, we have trained underwriters. So the client can either elect that we can contact that client. We can speak to them telephonically. We'll ask them a whole lot of medical questions, the medical history, and just to point out if they purchase in what we call a joint life annuity, so husband and wife, let's say, then we have to underwrite both. So we have to look at the husband and the wife, and so that's one option. We'll ask those questions telephonically, and then we'll do an assessment where we run that information through our system to calculate the price. Or alternatively, if the client doesn't want to be contacted, they can complete what we call a health profile questionnaire. So all that information contained in a questionnaire, and they just fill it out and they indicate all that information and the different conditions, and they submit that, and then we process it that way. So either or, whatever they prefer, and we then use that information to calculate a specific price for that particular member, and that's why we call that treating customers fairly. So the client gets the starting income that's based on their specific situation. Maybe just to point out that, so we've been doing this, what we call enhanced underwriting, or your enhanced annuities is perhaps a better word. We're doing this from the outset, and out of all our policyholders, just to share some stats with you, we would probably say about 30%, about just under a third of all our policyholders, when they came to Just, they received some type of an uplift in their starting income. Some of the uplifts are not large. Some of them can be around 3, 4, 5%. That's kind of your average uplift. But some of them are large because of some serious underlying conditions, where they can be 15, 20, 25% and so forth. And it's important to point out that that uplift is applied at the onset when the client starts the policy. So instead of starting, for example, with 1,000 Rand a month, he's now starting with 1,100 Rand a month. And that uplift can have a big impact and help the client, be able to meet some of their monthly expenses, which otherwise they wouldn't have. We often say to advisors that it wouldn't make sense not to offer it, because perhaps to point out there's no disadvantage or downside for offering underwriting. So we don't penalize you for being sick. We almost
encouraging them in a way.
Encouraging or almost allowing an individual to benefit if they've got those conditions. And that's how you treat customers fairly.
So can I ask, when you're doing the joint one, let's say the husband is now sick and he's been given a certain statistic on how long he's going to live, but the wife is really healthy. Would that still get an upliftment, or not necessarily, because it is a joint life? So what a joint life means is that husband will receive the income, and if he passes away, the spouse continues to get the income. With a life annuity, normally is if the person passes away, that income falls away and the capital would fall away, just to explain to the listeners. So now, if the one person is sick and the other person isn't sick, is there still a boost?
Another great question, Bronwyn. So certainly if it's a joint life and we have to factor both life expectancies into account, you can find that even though on the one, for example, in the case we're talking about the husband who might have some conditions, that uplift could be diluted to a certain extent when we then do the underwriting for the spouse who's healthy. Okay. So that definitely will and can have an impact, that if it's a joint life, if the one party is sick and the other one is healthy, it dilutes the uplift to a certain extent.
Okay. But the point is, you still get the uplift. You still get the opportunity to have an underwritten case if you're unhealthy, whereas it's not common in the marketplace, which is brilliant.
Yeah.
And another thing on that uplift, the increase will be on the total amount. So the example you gave, the 1,000 versus the 1,100. The next year it goes up by 7%. It's on the 1,100. Is that right?
That's 100% correct. Yeah. So your starting income is adjusted based on any uplift or enhancement at the onset when you start. So just maybe to expand, what happens is you come through to us, we'll automatically issue you with what we call a non-underwritten quote. So just your age, your gender, your fund credit, those basic criteria. and you'll see what that income is. You'll then, if you elect to, because it's not compulsory, you don't have to provide or do underwriting, although as we've said, there wouldn't be any downside to doing underwriting. You'll then proceed with the underwriting, either telephonically or through a health profile questionnaire. We'll process it. We use RGA, they are our reinsurers, so we send it through to them. And they assist us in assessing and pricing it. And then within 24 to 48 hours, we issue what we call an underwritten quote. And straight away, you'll see if there's an uplift or not. And if that then is accepted, the underwritten quote, that starting income is set with the uplift there and then, and it can never drop below that. That's how a life annuity works. You've got an annuity for your lifetime, and it can never drop. So that, and maybe just to point out to the listeners, that is one of the benefits of a life annuity, is that you buy an income for life, which doesn't get affected in any way by how long you live. So what we call longevity or mortality is taken off, risk is taken off the table. And any risk in investment volatility has no impact on the life annuity either. So that then will continue to pay for your lifetime.
So just one last question. I have found that sometimes people are quite scared to take a life annuity because they feel like, well, what happens if I die the next day?
Gone, yeah.
Then all my money's sort of gone. So one of the things that you guys do also offer, and the industry offers it, is a guaranteed term. So if the client gives that money, they're guaranteed that income for 5 years or 10 years.
Yes.
So now when you're doing these risk factors and someone takes a guaranteed term, do you still elevate the capital?
The income.
The income?
Yes, no, definitely. The guaranteed term, so maybe just to pause and explain to the listeners that when it comes to a life annuity, one of the concerns that many people have is that you hand in your capital over to the insurer and you're going to then lose. If you pass away, you've lost your capital. And that is true. So that's how these investments work. But remembering on the same token is that it will pay you an income for your lifetime, no matter how long you live. So if you live longer than the average life expectancy, you've definitely scored or done better than had you not lived longer. But then when it comes to a life annuity, one can also structure in certain what we call death benefits. So you can then say to the insurer, okay, here's my R1,000,000, you give me an income, but please, I want to protect myself so that at least I get a good percentage of that capital back. And the way to do that is to structure in what we call a guaranteed term, or another word for that is a minimum payment period. Insurers allow you to structure up to 20, sometimes 25 years of a guaranteed term on your policy. So the insurance company is going to pay the income for your lifetime, no matter how long you live, but at the very least, it's going to pay for that minimum term, 5, 10, 15, 20, however long you've structured.
So if it wasn't paying to you because you passed away, they nominate a beneficiary, right? And then that money would go there.
Yes, that's correct. Obviously, what's going to happen is that if you have a life annuity with that minimum guaranteed term, once you've passed away, you would have nominated at the outset on that policy who the beneficiaries are. And then you'd also have to set up front when you take out the policy whether you want the income to continue to be paid monthly or whether you want it to be paid as a lump sum to the beneficiary. So you must elect that particular option. And then all that would happen is we as the insurance company would then calculate either the lump sum for the remaining period of that term, or alternatively we'll continue to pay the income to the beneficiary. So it's either or, depending on which one the client selected.
So if we do the guaranteed term and the underwriting of the person being unhealthy, does that fall away? Or not necessarily? Because say, for example, a person that's only got 3 years to live, you would let them get a higher income, but now they've selected to do a 10-year guaranteed term.
No. So, Bronwyn, No, it wouldn't work like that. I mean, you come to the insurance company, you set up the terms and conditions of that life annuity up front. So you're going to say, okay, here's my capital. Please, can you give me an income, a life annuity? I want a certain amount of guarantee in terms of how long I want it to pay for. All of that is set up front. In terms of choosing the policy, and then once you've chosen those terms and conditions, the underwriting kicks in. So the underwriting is going to apply whether you've got the guaranteed term or you haven't got the guaranteed term.
Awesome. Thank you so much, Clive. Really appreciate it.
Thanks, Clive. Good insight. Thank you.
Thank you for listening. If you have enjoyed this podcast, would like to subscribe, please visit our website www.growthfp.co.za. The information we have provided in this podcast is our personal opinion. For more detailed information, please discuss your financial situation with a financial planner.